Although there is so much to comment on this finance bill, but due to limited time allotted to me, I shall be restricting my intervention to the implication of the income tax, the value-added tax, and the CSG. Mr. Speaker, we note that several measures announced in the budget speech have not found their way in the finance bill, and this is welcome. In my view, the Minister of Finance has realized that these measures were not tenable and will have serious adverse effects on our economy. This realization has come as a result of outcry from all stakeholders. There are other proposals such as CSG, which should be considered thoroughly in consultation with players of the industry. It is still not too late, and I urge the Finance Minister, in the interest of the country, to do so. Now, I will come directly to clause 42F of the bill. This is a very important clause of the bill. At the outset, it gives the Finance Minister wide powers under the proposed section 30F in the National Pension Act. Furthermore, the bill provides that the following will be prescribed by way of regulations. The affected participants, as provided in the clause 30A, the rate of the CSG, the amount of which the CSG should be applied, the time the CSG should be paid, the benefit in respect of the CSG. Such a major amendment to our pension landscape will be dealt with through regulations. We are taking about billions of rupees, retirement of hundreds and thousands of Mauritians, and more importantly about taxpayers' money. This will be done through regulations. This, in my view, and my friends in this House, and everyone in their sound mind will agree that this measure should be introduced as an act of parliament through a bill and debated fully by members of this House and involving all experts and stakeholders. Unless and until this is resolved, the whole of clause 42F should be kept in abeyance. The fact that the CSG is pooled in the consolidated fund, and so that the contribution made by a participant does not influence his financial benefit, implies that it is in substance a tax. This means that the employer contribution will not be deductible expense, will not be a deductible expense for the employer, as employer contribution is not towards the exclusive benefits of the employees. Furthermore, the CSG, the employer will pay will not be deductible on the basis that it is a tax. There is a provision in the Income Tax as there is no provision in the Income Tax Act. At the same time, the participant will be liable to tax on receipt of the retirement pension. Additionally, it is important to highlight that the CSG will be pooled in the consolidated fund and not a dedicated pension fund. And more so, its management falls under the Ministry of Finance and not that of the Ministry of Social Security. The interaction of the CSG with the Income Tax Act should be considered so that employers and participants assess its full impact. There is far too much uncertainty around this new proposal. Apart from the tax administration angle, there is a discriminatory part to its proposed measure, and in my view, unconstitutional. The private sector and self-employed are called upon to make a contribution towards CSG, while the public sector, although they will reap the same benefit, will not have to contribute a cent. This, in my view, Mr. Speaker, is very unfair, and I said it might be unconstitutional. Also, why would a company pay its additional tax when there are already private pension plans in place? This will in turn affect insurance companies and pension funds, surely. This measure will have a ripple effect in downgrading our economy. Before introducing such a measure, the finance minister should have taken into account the fundamentals of the Mauritian economy, its workforce and its social fabric. I stress again, engaging with stakeholders is a must, and this has been the practice of past finance ministers. Now, Mr. Speaker, let me come to income tax. Clause 28P, subsection 2. The proposed subsection 2A provides that the tax to be withheld under the PAYE should include the levy once the emoluments exceed 230,769 per month, that is a threshold of 3 million on a yearly basis. The fact that the levy applies to resident individuals only applies at a minimum that the individual is eligible to Category A income exemption threshold. In practice, this presupposes that the employer has the appropriate evidence of the fact that the individual is resident in Mauritius. Considering an amount of 325,000 rupees, an individual with a yearly emoluments of 3 million will not be liable to the levy, and his chargeable income will be computed at 2,675,000. If the levy is maintained in accordance with Clause 28, the threshold of 233,769 rupees should be applied to the chargeable income of the individual. I think there the Honourable Minister of Finance still can change this figure. Mr. Speaker, sir, Clause 28H of the bill, electronic tax return. Electronic tax return will be compulsory as from year ending 30th June of 2021. At the same time, the submission and payment date will be 15 October. Government cannot impose the electronic submission and payment of tax. There are a number of perfectly valid reasons as to why a number of individuals do not favor electronic submission and payment of tax. For example, a small taxpayer, a layman who has to pay his taxes, who does not have the facilities of IB, of internet banking, what does he do? Not everybody has a computer at home. Not everybody has internet access. This creates a prejudice and may be subject to tax evasion as well. He cannot seek the help of someone else or family member, as this may create problems such as disclosing confidential and private details. The option of not submitting a tax return and its payment electronically should be kept, even if that means that the submission of tax payment be 30th of September. In my view, the compulsory submission of tax return electronically can be maintained for corporate entities and high taxpayers, but not for individuals generally. Mr. Speaker, sir, Clause 28C of the bill, taxing of high income earners. Even with a single tax rate, the high income earners suffer a higher amount of tax in view of the fact that the tax base is higher compared to individuals with a lower taxable income. Hence, there is no need to a higher tax rate to redistribute income from the rich to the poor. Currently, we do have a tax rate of 10% for a category of individuals. The drawbacks of different tax rate, Mr. Speaker, sir, having more than one tax rate is not desirable and prompts and incites taxpayers, both individuals and businesses, and business communities, to implement tax arbitrage strategies. Such a behavior is commonly and internationally and at international level, and is one of the main reasons of the base erosion and profit-sharing project of the OECD. Any variance in the different tax rates should be minimal. Currently, a domestic tax company is taxed at the rate of 17%, considering the 2% of corporate social responsibility. Our former tax regime, that is a flat rate of 15% across all income classes, has been an important selling point of our jurisdiction and have always been lauded by the international community. This has, among other matters, reduced tax administration costs, and history has proven that since we introduced this flat rate, our income tax revenue has increased compared to when there were different tax rates in the past. First, Mr. Speaker, new tax regime is discriminatory among businesses. A company is not subject to the levy, so that it only impacts on the taxable income and Mauritian-sourced dividends and of individuals. Taxpayers engaged in the same activities are therefore subject to different level of taxes. With the proposed measure, it is certain that businesses will restructure their business activities. Whilst there are anti-avoidance clauses in the tax laws, such anti-avoidance laws cannot counteract any lawful tax mitigation strategies. Certain businesses cannot be undertaken by a company so that the levy would be a direct cost. Hence, the profit realized from activities of the same nature with the same level of business risk would be taxed at significantly different tax rates. Now, Mr. Speaker, let me come to dividend, as mentioned in the bill. Dividend income from Mauritian tax companies. Dividend is a return on the investment by a shareholder. Taxing dividend gives rise to economic double taxation. The dividends have already been taxed at company level, that is at 15%, and will be taxed in the hand of a shareholder at a minimum additional tax of 10%. This is what we call double taxation on the same profit. It does not place all shareholders on equal footing. Foreign non-resident shareholders will not be subject to an additional tax in Mauritius on dividends received from a Mauritian company. This is clearly for me a disparity, Mr. Speaker, sir. Dividend, now I will say a few words on dividend income from foreign companies. A foreign dividend is eligible to foreign tax credit, so that the Mauritian tax on the dividends is reduced by the foreign tax suffered if the Mauritian residents own at least 5% of the share capital of the foreign company. With the levy, the individual is not able to claim underlying foreign tax credit on any of its foreign sourced dividend. Mr. Speaker, sir, dividend income of a resident partnership or succession. As from the income year 30th June 2020, dividend of resident partnerships and successions are also included in the tax base of the individual for the purposes of the levy. This means that the individual may be taxed on an income that he may never actually received. A resident partnership may be engaged in a number of activities. The level of its drawings depends on its financial performance as a whole, whereas a partnership or succession I say where the partnership or succession, as the case may be, incurs a loss on the dividend income, the loss cannot be used to reduce the tax base for the purposes of the levy, Mr. Speaker, sir. If the levy is maintained, it should be based on the rate of 2% on the chargeable income of the company. Mauritian source dividend should be excluded from the above reasons. On the other hand, other income like bank interest may be considered. Bank interests are generally deductible in the computation of taxable profit for banks. Mr. Speaker, let me now say a few words on VAT. Clause 70B of the bill. A new subsection 2A is to be introduced, Section 5 of the Value-Added Tax 1998. The new subsection reads as follows. Where services are provided to a ministry, government department, local authority, or Rodrigues Regional Assembly under a construction works contract, the supply shall be deemed to take place at the time payment for that supply is received by the supplier. Section 5 of VAT 1998 is essentially provides that the output tax is payable on the earlier of the issue of an invoice or payment. Hence, a VAT registered person is required to account output tax once an invoice is issued, even though by the time the VAT return is submitted, the debtor has not paid the registered person anything. The proposed new subsection 2A implies that the output tax on services under construction works contract during the period starting on 1st October 2020 and ending 30th September of 2022 will be accounted by a VAT registered person on a cash basis. However, the cash basis only applies to services provided to a ministry or government department, local authority, Rodrigues Regional Assembly, and not services to other persons. Mr. Speaker, sir, this proposal is totally discriminatory. Why is it discriminatory? Because in my view, the fact that a registered person who provides services under construction work contract during the period I just mentioned to a person other than ministry, government, or local authority, or the Rodrigues Regional Assembly, is still required to account the output tax on the earlier of the issue of an invoice or receipt of payment. If it is a policy decision to account output tax on a cash basis during the 24 months I've mentioned, it should be applied to services provided to all persons. It can't be discriminated between private companies and government entities. This is why I say it is discriminatory, Mr. Speaker, sir. Also, Section C of the bill, Section 12(3) of the Value-Added Tax 1998 will be repealed and replaced by the following. The value of the supply shall be taken to the open value of the supply or such other market value of the supply or such other amount as the Director General may determine where the supply is for a consideration not consisting or not wholly consisting of money or not made in the course of an arm's length transaction. Currently, Section 12(3) of Value-Added Tax reads as follows. If the supply is for a consideration not consisting or not wholly consisting of money, the value of the supply shall be taken to be the open market value of the supply or such other amount as the director may determine. So, Mr. Speaker, sir, Section 12(3) of Value-Added Tax 1998 already provides that the value of the supply is the open market value, where the consideration is not wholly and in money and empowers the MRA to determine another value. This is the difference and the amendment being made. We already have, therefore, two valuation methodologies in the Income Tax Act, where the consideration for supply is not wholly in money, the open market value, and the value of the MRA may indicate. With the proposed amendment, the above two valuation methodologies may apply where supply is not made in the context of an arm's length transaction. This may apply in case where a company, where a sole trader decide to put, as we say, a promotion on his items. The MRA can state that this transaction is not at arm's length transaction. This, we already giving additional powers to the MRA. As the laws stand, the MRA is empowered to adjust the taxable value so that we end up with a VAT outcome that departs from the neutrality principle. Most importantly, creates an uncertainty in genuine business transactions. The approach of the MRA may lead to VAT being imposed on fictitious income. VAT Act 1998 does not have any corresponding adjustment so that any adjustment made by the MRA will breach the neutrality principle. Section 36A of the VAT 1998 is wide enough to catch cases of abuse and was introduced by Section 29D of the Finance Act 2000. For this purpose, tax advantage includes any reduction in the total consideration payable by any person in respect of any supply of goods or services. For all the reasons that I have just mentioned, Mr. Speaker, the proposed amendment should not be implemented. If any amendment is required to Section 12 of the Act, the discretionary power introduced by Section 30 of the Finance Act, or the Finance Miscellaneous Provision Act 2013, should be removed, Mr. Speaker, sir. Now, Mr. Speaker, sir, let me say a few words on tax on online services. Taxing online services such as streaming, cloud, social media, instant messaging, Dropbox, Facebook, WhatsApp, Messenger, YouTube, Google Drive, OneDrive, Gmail, Hotmail, Yahoo, and so on, is merely a measure to fill the coffers of government, to the detriment of the Mauritius public, and especially the youth. Our youth is the future of our country, and we rely heavily on electronic means in the advancement of their education and their career, especially in the context of COVID and post-confinement. This measure is a major drawback and should be rethought. The Minister of Finance should look at this measure more holistically. And coming to the technicalities of the bill, clause 70E of the bill. A foreign supplier will be required to charge VAT on any digital electronic services. For this purpose, a foreign supplier is defined as a person who has no permanent establishment in Mauritius and supplies in the course of his business digital or electronic services to a person in Mauritius. Digital or electronic service is defined as services supplied by a foreign supplier over the internet or an electronic network which is reliant on the internet or by a foreign supplier and is dependent on information technology for its supply. Mr. Speaker, sir, the regulation will provide the manner in which VAT will be charged by the foreign supplier. The regulation will also provide the services that will fall within the scope of this provision. We are hoping that the regulation will be discussed with all relevant stakeholders. The treatment for services rendered by a non-resident to a Mauritian person through traditional mediums should be clarified, because it's not sufficiently clarified in the bill. Mr. Speaker, we also assume that exempt and zero-rated services will be treated in the same manner. Otherwise, this will discourage the trade of exempt and zero-rated supplies through an online platform. It is certain if a foreign service provider will still be, it is uncertain rather, but if a foreign service provider will still be required to charge VAT on a transaction that has always been subject to VAT in his country of establishment. That is, if it has already been taxed in his country, whether it will be taxed again to Mauritian. If Mauritian VAT is applied irrespective of the amount of VAT charged by the foreign service provider in its country of origin, the total VAT charged by the foreign service provider may be above 15%. Now, Mr. Speaker, to conclude on clause 70H of the bill, a new subsection is to be introduced, section 21.3 of the VAT 1998, where a registered person is engaged in a project spanning over several years, and the Director General is of the opinion that the apportionment in accordance with paragraph B is not appropriate. The Director General may by notice require the registered person to apply an alternative basis of apportionment of input tax. Mr. Speaker, sir, section 21.3 of VAT 1998 provides a methodology a registered person is required to apply where the person is engaged in taxable and exempt supplies and is based on the proportion of the value of the taxable supplies over total turnover. A person may apply for an alternative basis if it is proved to the satisfaction of the MRA that the apportionment methodology under section 21.3b of VAT 1998 is not fair and unreasonable under section 21.3 of VAT 1998. The alternative basis may only be applied by the registered person if it is approved by the MRA. With the section proposed 21.3 of VAT 1998, the MRA will effectively impose an alternative basis on the registered person. A minimum, Mr. Speaker, sir, a minimum of consistency is required in the application of any law. We must not forget that irrespective of the strength of an alternative basis, the approval of MRA is already required under section 21.3 of VAT Act 1998. So, Mr. Speaker, sir, I have made my point, and as I said earlier, that we still have time to consult the stakeholders before the introduction of the CHG, because this is a very important clause of the bill, which will have drastic consequence on the economy. Thank you, Mr. Speaker.
Remember that we suspend for 1 hour and a half.